Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this episode of the Moneymakers podcast, we're doing something slightly different from normal. And instead of talking to someone who's working directly in the investment trust sector, we're going to talk to a global market strategist, this being Hugh Gimber, who's an executive director of J.P.Morgan Asset Management and is a global market strategist based in London. The reason for doing this is, of course, that there's so much going on at the macro level at the moment that a lot of investors are, frankly, pretty confused about what's going on and are deeply uncertain about the future and what it all means. So, Hugh, I'd like to start off by actually picking up on that point and saying to you, global market strategy must be one of the harder periods in your professional career where there's so much uncertainty at the moment, particularly about what's happening in the US with President Trump at the helm.
It certainly is. First of all, thank you for having me. I think the point you make about uncertainty is spot on. And one of the ways we can measure this is by looking at the number of newspaper articles, for example, that are talking about the level of trade policy uncertainty. So when we look at the amount of coverage that that's receiving today relative to, for example, President Trump's first term and the trade war that we had between 2018 and 2020, what we're finding from those metrics is that trade uncertainty is as high as it's ever been. And from an economic perspective, obviously that matters because the higher the level of uncertainty, the greater the inclination for businesses simply to press pause, whether that's on hiring or whether that's on investment. And that's exactly what you've been seeing playing out in the markets this year, with investors becoming increasingly wary about the growth outlook simply because of people holding back instead of taking decisions.
Right. So uncertainty is a real positive factor in financial markets. So do you think the uncertainty stems from confusion about what President Trump and his administration is trying to do, or simply the fact that there doesn't appear to be a huge amount of consistency in what is coming out of the White House?
I think it's the volatility of the policy announcements that we've seen so far. Take the announcements that we first had at the start of February on tariffs towards Canada and Mexico, where they were announced a 25% tariff on goods coming from both countries, and then just a few days later they were walked back. And so at the time, the market said, okay, we can assume that tariffs are purely a negotiating tactic, and therefore that this is all sort of rhetoric and we can look through this. What's changed over the past couple of months is that the rationale for imposing tariffs has become that much broader. It's no longer just about trying to achieve foreign policy goals, for example, trying to stop the flow of fentanyl or other drugs crossing the US borders. Rather, now you're talking about reshoring manufacturing or potentially raising lots of revenue through tariffs in order to fund tax cuts further down the line. So as that rationale for imposing tariffs becomes a lot broader, it's becoming more difficult for markets to understand the extent to which these tariffs are simply a negotiating tool that will quickly be rolled back, or actually something that we're likely to be living with for much longer.
So if we look at the broad platform which President Trump was putting forward before the election, and which I think helped to prompt the market surge after he was elected, that's now gone into reverse. But basically it was built around the idea of tariffs, as you've mentioned, tax cuts potentially, and also a lot of deregulation, which might or might not make a difference in the hands of Elon Musk and others. Of those three, are you saying that the tariffs are the one that's caused most concern so far, and we aren't yet sure whether we're going to see those tax cuts come as well?
Exactly. I think that's spot on. And the key difference here relative to President Trump's first term is that unlike in 2016, where we got lots of the good economic news first, and then some of the tariff headwinds started to hit later on, this time round, the focus in the first 50-odd days of the administration has been on tariffs. And so we know further down the line, there's the potential for tax cuts, there's the potential for deregulation, but we lack a lot of detail on both of those points. Whereas we can already start to incorporate the uncertainty and that pausing of business activity that I was describing on the economic outlook today. So it's rather the structure and the ordering, and I'd say we're in the phase now where the bulk of the potential headwinds to growth are becoming better understood, but we're still yet to understand where some of the more positive aspects for the US economy could be delivered by this administration at a further stage.
So at this stage, we only know what we've learned so far, And as you suggested, overall, the impression seems to be that it's pointing towards slower growth than was originally expected, and also the risk of higher inflation, which is also something which I think is exercising the bond market at the moment.
I completely agree with you. It's this balance of growth and inflation that's so difficult. I think there's always a temptation for people in my types of role to talk about high levels of uncertainty, right? It's a bit like a weather forecaster. They're always going to say predicting the weather is difficult because they want people to understand that their job is hard. But I think the specific aspect of the uncertainty in 2025 is not so much that we could be facing a slowdown in growth, because any year you know that there are risks to both sides of the growth outlook. Rather, what's uncertain about this year is the balance of risks between both growth and inflation. So potential downside risks to growth and potential upside risks to inflation stemming from tariffs. And then layer onto this the fact that we came into this year with most investors expecting a very, very strong year for the US economy. Trump was going to make America great again. We were told that by the president himself. And therefore, relative to expectations, it's not just that the US economy now looks to be slowing. Rather, it's slowing against a starting point for most investors that were looking for much, much more robust levels of US activity and an assumption that Trump was going to be much more negative for other parts of the world.
We haven't yet mentioned Ukraine. How does Ukraine fit into this particular pattern? I mean, we don't know, of course, again, whether there is going to be a ceasefire or even a lasting peace deal. We don't know whether that's going to be a factor. But if there is, how do you think that would play out if Russia is admitted in some form back into the global economy, if you like, the open market economy? Is that going to be an important influence that might change people's expectations this year?
I think there are three key channels that we're tracking when it comes to Russia-Ukraine. The first is defense spending. And to be blunt, this is where we actually have a lot more certainty, because the approach from both the European Commission and Germany specifically has said that they now believe is the right time to do a significant increase in the amount that countries are spending on defense. And this is the type of news that you only get really once a decade. Friedrich Merz, the next German Chancellor, has used the phrase, "We will do whatever it takes to ramp up defense spending." And that was a very specific choice of words, because we'll remember Mario Draghi back in the sovereign debt crisis used specifically that phrase. So we're taking this very seriously. And I think regardless of how negotiations play out, it's now clear that the European economy will receive more support in the future from significantly more spending on defense. Where there's less clarity today are around the other two channels. So the first is consumer confidence and the second is gas prices. And clearly those two are linked. We know that consumer confidence in both the Eurozone and the UK was hit in 2022 as a result of the increase in gas prices. And this is where the nature of a potential resolution matters, because Europe's willingness to buy Russian gas at some point in the future again obviously will dictate the impact on prices, and the extent to which you see an improvement in the outlook for gas prices then feeds through into how confident consumers will be feeling about the future and their willingness to spend down the savings that they were putting away during the pandemic. So on defence, we're confident that is a significant improvement to growth. On the consumer confidence and the gas price side, we know those are the potential channels for a resolution to hit the economy, but it's a lot less clear at this point to what size or how quickly that impact will show up.
So just on that little point before we move on, obviously there's been some people now talking about the risk of a recession in the US. I'm not sure that's what you're saying, but we do know from history that when we get recessions, they tend to be associated with rising energy prices before the recession occurs and obviously lead to lower prices after it occurs. But do you think there is actually a significant risk of a recession in an economy which has been growing as fast as the US has been?
Recession risk is rising, but I still don't think it's the central scenario for this year, for a couple of reasons. First of all, we came into 2025 with very good momentum in the US. You've seen, as you say, these really couple of years where growth has been well above average levels, and that helps. Economies are momentum machines, and so the fact that we started 2025 in a good place is important. Similarly, corporate fundamentals, i.e. balance sheets, are in good shape. Consumers look to be in relatively robust health as well. And so the scenario that we're looking at as our central outcome for the US economy today is one of a slowing economy, but not one that's tipping into recession. But let me come back to that point around businesses pausing activity. Effectively, what we're saying is that a pause in activity, a pause in hiring slows growth. We're not yet at the point where that pause becomes actually layoffs, forcing unemployment up and forcing the economy into recession. So today we see this uncertainty as a slowing effect, but obviously the longer that uncertainty continues for, and the longer trade policy remains this volatile, the greater the risk that you see businesses not just holding back on investment or holding back on hiring, but actually moving to shed workers and therefore leading the economy into recession.
And of course, there's also one other factor which we haven't mentioned so far, which is immigration, and the reality that the Trump administration is trying to deport a lot of illegal immigrants from the country, and yet they do some very important jobs in the US economy. So that, I guess, is designed to help improve real wages for those who are working in the US. Do you think that's going to play out as well? How do you see that being a factor?
Yes, so we're already seeing in some of the higher frequency data that just the rhetoric around immigration is causing a slowdown. This comes back to the really fundamental point that we spoke about earlier on in terms of the balance of risks to growth and to inflation. Because a significant slowdown in immigration to the US, you would expect to weigh on growth because you're slowing the supply of labour, but you're also going to tighten the labour market up and therefore create the potential for rising wages, as you say, because there are fewer workers to do the same number of jobs. And so this is where that policy mix is so challenging at the moment. You understand the potential downside risks to growth, you understand the potential upside risks to inflation, and where that levels out today is something that we're all spending a lot of time trying to work out, but is frankly a very difficult equation.
So in this context, we're recording this conversation before the latest meeting of the Federal Reserve's interest rate setting committee. And it does seem likely that against this background that we've been talking about, with this uncertainty and the potential risk of higher inflation, we're probably not going to get an interest rate cut from the Federal Reserve for the moment. And that will also play into investors' minds, I guess. Can you tell us what you think is going on in the bond market in response to all this? I think we better start with that.
Of course, I mean, the bond market's been all over the place, frankly, so far this year. So we had a pick-up in yields earlier in January, where more of the focus was around some of the upside risks to inflation. More recently, you've seen bond yields coming down and bond prices going up as the focus shifts from some of the upside risks to inflation to some more of the downside risks to growth. How the Fed are thinking about this, I think basically you can say, well, at the moment, if it ain't broke, don't fix it. We know that the economy today is in an okay place, and we understand the potential risks to the future are two-sided, and therefore simply we're going to wait. We're going to leave interest rates where we are because they know that I think the last thing they would want to do during this 4-year term is to be hiking rates at some point in the future. You don't want to be accused of trying to actively slow down the US economy. And therefore, if you know that's what you want to avoid, I think the temptation now is to say, well, rather than continuing to cut rates and then potentially create a situation further down the line when we start to have to take rates higher again, we're simply going to wait. And we'll only think about cutting rates again once we've got a much clearer signal that the economy is slowing than the data is showing you today. So I agree. I think the Fed's on hold this week, and they'll frankly be doing as good a job as they possibly can to offer very little guidance about where they go in the future, because they know at the moment there's this growth and inflation trade-off, which is very difficult to work out.
Now, we've been talking all this time, obviously, about what's happening in the US, and that's fundamental to the global economy and to global markets. But perhaps a quick word just on Europe and then the UK. What are your expectations there in terms of growth and inflation?
Yes. So first of all, when it comes to the Eurozone has been struggling, frankly, for the past couple of years and is now seeing finally some policy response. And so at the moment, I think the European growth outlook looks a lot brighter today than it did just a few months ago as a result of that defence spending plan that I was describing earlier. Similarly, we have the ECB, the European Central Bank, with a bias to keep cutting interest rates as a result of relatively low inflation. And Europe is a very rate-sensitive economy. Corporates often rely much more on bank loans, for example, than they do tapping the credit markets. And the reason I bring that up is because when interest rates come down in Europe, that then feeds through much more quickly into the real economy than we'd see in the US. So far, you're looking at a European growth backdrop which is relatively weak, an inflation backdrop which is relatively low. But I think the change this year has clearly been an improvement to growth. The UK, unfortunately, probably in a slightly trickier spot because we have some growth headwinds, but we also have a bit more inflation pressure. And it's clear post the budget in October that inflation expectations are starting to rise. And therefore, I still think this is going to be an okay year for the UK economy. We are relatively well insulated from tariffs than, say, the Eurozone because our economy is much less dependent on manufacturing than some other parts of the world. But against this backdrop where you have fairly muted growth, but still pretty sticky inflation, I think the Bank of England needs to be wary about cutting too quickly. So I guess what we're coming to is a period where, unlike much of the last few years where central banks have broadly been moving in tandem, you now have the Fed, the Bank of England and the ECB all facing quite different mixes of growth and inflation in their economies, and therefore policy paths which are quite likely to diverge.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to J.P.Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector with links to the relevant stock exchange announcements, and many other regular features including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's then talk a little bit about what this all means for the financial markets, because obviously that's really what investors' concerns are. We can all talk about the uncertainty and so on, but we have to make some decisions about what we do with our money, whether we do anything at all, of course, being the first question. Let's just start by one particular specific that relates to the US equity market, and that is this idea there was such a thing as the Trump put, to sit alongside what was used to be called the Fed put, which is this idea that if the stock market starts to tank, that policy action will follow either from the administration or from the Fed. I think it's become pretty clear that people who are hoping that that was in place, or either of those are in place, are going to be disappointed in those hopes, at least the way things are going at the moment.
Yeah, so this concept of the Trump put, i.e. the lower the equity market becomes, the greater the pressure on the administration to change their course and to effectively become more market friendly. I certainly agree that the level of market volatility that this administration is willing to tolerate appears to be greater than I and many others would have anticipated coming into 2025. I'm not convinced it's not there at all, though. I'm not convinced that this is an administration that is simply willing to ignore what's happening in the economic data or what's happening in the market and make no changes whatsoever. I personally still do believe that the greater the market or the economy shouts about some of the challenges being created by this policy mix, still the greater the incentive for deals to be struck at some point later in the future, but acknowledging that this is a more disruptive policy mix than I think many would have anticipated coming into this year. So for the S&P 500, I think there's a danger of becoming too negative as the headlines keep flowing, because we've seen how policy can change very, very quickly. We've had many examples of that so far this year already. But rather the focus for us within the US market is how to find a slightly more defensive allocation. So maybe that's a different sector mix, for example, with some of the traditionally more defensive sectors like healthcare or utilities or staples having a bit more of a role to play in a well-diversified portfolio than the very tech and cyclical mix that has worked so well over the past couple of years.
We heard last week from Scott Bessent, who's the Treasury Secretary of the Trump administration and former hedge fund manager who certainly understands markets. I mean, he said that he wasn't worried about the fact that the S&P 500 has fallen by 10%, which some people call a correction. He wasn't worried about that. And he was implying, therefore, that they can live with some of that volatility. A lot of people have been saying, well, the fact that we've got somebody who understands economics and financial markets at the Treasury is a positive against the somewhat uncertain credentials of the rest of the administration. Does that give you any comfort?
I mean, there's a diverse mix of backgrounds and policy experience with the administration quite clearly. Now, I think you're right to highlight that many members of the administration have said so far, no, we're not focused on the level of the S&P 500. And I think that talks to some of the uncertainty in markets today. Think forward, though, we have the midterms coming up, really not that far away. This is going to be coming at us thick and fast. And so if we were to play that scenario out and you get to the midterms in late 2026 and the market is still under pressure, the economy is under pressure, and you'd had no pivot whatsoever from this administration, you're going to have a lot of Republicans in both the House and the Senate under real pressure to defend their seats. And we know, one of the easiest ways to change policy direction is when politicians start to fear about their own positions. And so I still do believe that over time, we are likely to see some concessions, some recognition of the economic and market volatility that this policy mix is causing. But in the short term, I think we do have to be ready to ride out significantly more volatility ahead.
So in terms of the global equity market, we know this has been living through a period of extraordinary dominance by the US, accounting for some 65-70% of the world equity market capitalization, despite being only 20-25% of the world economy. And we've seen the US market underperform the rest of the world so far this year. Given all that we've said, do you think that is a trend that is going to continue and investors should be aware of when they're deciding whether to shift their allocations or not?
Yes, is the short answer. I do think this is a trend that can continue because of the change in expectations, right? Expectations really matter when it comes to financial markets. So although at the moment we're still looking at a world where US earnings are expected to outpace European earnings and the US economy is expected to grow more quickly than the European economy this year, it's relative to expectations, which explains why we've seen such a shift in regional equity performance. And I think the big picture point is that regional diversification, sectoral diversification in equity markets is working again. So lots of this discussion has been relatively negative, I think, so far, and I'm probably guilty for lots of that. But European equities are up in 2025. UK equities are up. It's only really the US equity market that's been feeling the brunt. And so obviously we always see things like diversification is important. But what's different today is that diversification has not worked for 2 years. The best strategy possible in 2023 and 2024 would have been to hold a very small number of very expensive, very popular stocks in the US and ignore any traditional fundamentals about investing, right? Park diversification, just focus on owning US tech. And the good thing about 2025 is that diversification is now working again. Whether that's regionally, whether that's at a factor level between, say, growth and value, whether that's sectors, and that means it's still really possible to build well-diversified global equity portfolios today, despite many of the challenges that we're highlighting when it comes to the US outlook in particular.
And so within that, can one go as far as suggesting which of the main regions look more attractive on that basis for diversification purposes, that is?
Of course. So I think for me, Europe and the UK are more interesting. When you start to look further east, Japan and China, I think, are more challenging regions of the world for slightly different rationales. China, a domestic economy that's still facing significant headwinds, that has not yet seen the policy response that we think is required to sort out the challenges in the real estate market. Japan, for slightly different reasons, where you have an economy which is picking up very healthily, but therefore with the prospect for a stronger Japanese currency, which we know can often put pressure on the equity market. Whereas in Europe and the UK, yes, you've seen a bounce in valuations. Yes, you've seen significant outperformance year to date. But relative to the US, those valuation gaps are still wide. And so I still think there's more room for that rotation from the US to the rest of the world, but particularly Europe, to play out in 2025, albeit acknowledging the call really. I don't think this is a great time to be taking big, active positions in one region or another. Rather, we're talking about spreading regional risk, maybe with a little bit of a bias towards Europe. But when so much is uncertain, generally diversification is your friend. And as I say, it is finally working again.
And given that the outlook for bonds and equities has changed quite significantly in a way from where we were towards the end of last year, do you think that there's many people who've been arguing that this is a time for small cap to finally come out of the shadows against larger capitalized companies? Do you think that will finally happen? It hasn't happened so far this year. It's been the other way around, if anything. So what are your thoughts about that particular form of diversification?
I think on small cap, the periods in the economy where small cap generally works best are those where you have an economy which is recovering off a weak base. Right? Imagine a period where you're coming out of recession, where expectations have been hit hard and you start to have economic momentum re-accelerating and interest rates still low. That's generally the sweet spot for small cap companies. We would describe them in the industry as an early cycle opportunity. In other words, it's the start of an economic cycle when they work best. I actually think at the moment we're much closer towards the end of an economic cycle. We would describe this as a late cycle phase, and therefore it's a time where growth is slowing, and so far interest rate burdens are still pretty high. We've not seen major rate cuts, and small caps we know are very rate sensitive because they tend to borrow much more money on much shorter term agreements, and therefore, the best environment for small caps is generally one where you have low interest rates and a re-accelerating economy. Rather, I think, unfortunately today, we're sort of on the other side of that spectrum with a slowing economy and still elevated interest rates. So in short, our preference today is for large over smaller companies, and generally that coincides with a view that higher quality companies, stronger balance sheets, for example, will help ride out some of this market volatility.
And one other point I can put you perhaps on asset allocation. A lot of people have obviously noticed the amount of money you can get from cash or from money market funds or indeed from a lot of high-yielding instruments. They've noticed that, and of course, perhaps for behavioural reasons, it's become that people have shifted into those types of asset and will be reluctant to come out of them, given that they're still think 5% a year or whatever it is a very attractive return. Do you think that's the behavioural factor, or is it actually an economic factor that should be driving people's investment attitudes at the moment?
It's certainly tempting, but we would argue based on history that for the vast majority of people, hiding out in cash due to economic volatility or geopolitical concerns is the wrong strategy. And we did some work on this just a couple of months ago where we said, right, hypothetically, what if I was the worst portfolio manager of all time? And I tried to time markets by simply investing right before some of the biggest economic shocks that we've faced over the past 20 years. So think outbreak of war or some of the elections that have been that surprising. And what if I had gone in just before that market volatility had hit as a result of the shock? And what you'd find is that in the vast majority of times, over a 1-year horizon, you still would have outperformed cash in a 60-40 portfolio. And in almost all scenarios, over a 3-year horizon, you absolutely would have outperformed cash with that diversified portfolio. So I think there are many reasons for investors to hold cash, but rarely is it due to economic volatility or geopolitical concerns that would be a good rationale for that shift back into cash, albeit at relatively high interest rates today. Add to the fact that we think central banks are on still a cutting bias and that interest rates are likely to be coming down over time. I think there's significant opportunity cost in hiding out in cash today, despite, I come back to that word uncertainty, all of the uncertainty that we're describing about the outlook.
Would you say the same for, let's just take two other asset classes, if you like, sort of index-linked and corporate bonds, slightly different instruments, of course. What are your views on those two particular asset classes?
So let me take corporate bonds first of all. Obviously, the way we think about corporate bonds is generally the extra compensation that you get or the spread that you get for investing in corporate bonds relative to investing in government bonds. And that compensation today is relatively small. Spreads are quite tight. However, that's because corporate fundamentals are in decent shape. So provided that you feel confident that we will not see a recession over the next 12-18 months, we think that should align with corporate bonds outperforming government bonds. But it all comes down to that view on recession. We say credit is a no recession asset class. Provided the economy is holding up okay, generally you will see corporates outperform governments. On inflation-linked bonds, I really don't like the word inflation-linked bonds. I have to say, I think it's quite a confusing name for them because people look at inflation-linked bonds and think, I can use them to hedge against inflation. And rather, you should almost forget about the inflation-linked and remember they are still bonds. Right? Inflation-linked bonds still don't like inflation. They just don't like them slightly less than traditional bonds. And so for me, the case for assets in a portfolio that can diversify against inflation risks this year is a really important one. But I'm not convinced that inflation-linked bonds are the best way to do that. Rather, we would prefer to look at real assets as a better inflation hedge over time. Take infrastructure as a good example where you might have assets that are contractually linked to the level of inflation because the amount of money that they earn goes up in line with inflation every year. I think that is a more reliable diversifier against inflation risk over time than using inflation-linked bonds specifically.
And I think that makes you, along with many people in your profession, but not perhaps in the private investor community, a little dubious about gold as well. I mean, gold has been an extraordinary performer over the last couple of years. And I think over long term, the current moment has outperformed equities as well, if you go back far enough and pick your starting point with some care. But what are your thoughts on that?
Frankly, from my sort of position, gold is an incredibly difficult one today. If I still had hair, I'd still be pulling it out, I think, because what we've found with gold over the past couple of years is that it has broken away from all traditional fundamentals. Go back to prior to 2022, and you tended to see a pretty good link between gold and specific measures in the bond market, real yields in particular. So as the opportunity cost of holding gold went up, generally the price of gold would come down, and vice versa. And what we've seen ever since Russia invaded Ukraine is that that link has broken down entirely. In other words, the gold price has moved away from fundamentals because as Russia was cut off from the Western world, other central banks around the world have been saying, well, how comfortable am I really holding US government bonds or UK government bonds if these could be seized at a later date? And perhaps I'd rather hold gold instead. And therefore, you've seen this shift in central bank reserves away from Western government bonds and towards gold. And that's forced prices up a very long way. But it just makes trying to model where the gold price goes from here incredibly hard, because all of the traditional measures that we would have looked at and the outlook for real yields in particular now simply doesn't work. So I think if you're buying gold at these levels, maybe you view it as an inflation hedge. Maybe you don't have some of the real asset options that I've described, but you're probably doing it less because you have great conviction in where the price is headed, and rather you're thinking about it as a potential diversifier, regardless of the price level today.
So if we take this whole picture then together as a single view, what do you think are the greatest risks to your expectations at this point? I mean, I always ask this question, and of course, it's difficult to answer because all sorts of things could happen. We know that one definition of risk is that more things could happen than will happen. To ask you the what keeps you awake at night question, what's the thing that you're most unsure about?
So I think the risks to the view that I've laid out today primarily are linked to the uncertainty that we face in trying to predict US government policy. That is the main challenge. And I should stress those risks are two-sided. I may have laid out too sanguine a view, and I may be overly confident that economic and market volatility will influence policy over time. Of course, I also may be far too negative about the world because we could be looking at a much quicker pivot than I anticipate. We simply shouldn't be trying to position portfolios today with any high degree of confidence about the exact level of government policy. When I think then around the rest of the world, I do think China will have a say this year as well. And this is another area. When I think back to 2022, take zero COVID policy in China as a great example, where everyone had their own theory for when that policy shift might come and when it might be removed. Which economic conference could it be when they pulled back that policy? Instead, we should have said at some point this will change and we will react accordingly. And it was one random day in November 2022 when that policy was removed overnight and the Chinese economy went to the races. And so this, I think, is another area we need to keep an eye on. Policy visibility is relatively low, but a significant shift in stance from Beijing could be a potential surprise to us all in 2025.
So on that note, I'd like to thank you, Hugh, for your excellent survey of what's going on around the world. Plenty to think about there, and plenty to translate into decisions that one may or may not be making about where to put one's money in 2025 and beyond. So that was Hugh Gimber, who is an executive director at J.P.Morgan Asset Management and a global market strategist based in London.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.